Alrighty. Well, welcome everyone. I appreciate those board members or potential future clients who are able to join this evening for our latest installment of Westward 360's Board Education Program. I do see some familiar faces that have been at some of the prior events that we've held through our education program. So nice to see some repeat faces and customers. Just as a little bit of point of background, we've been doing these sessions since about July of last year, just on a variety of topics that are near and dear to your hearts, I'm sure, as fiduciaries and board members at your respective communities. So whether we've tackled topics like reserve studies, insurance trends that we're seeing in the volatile market, things around legal updates that might be changing for both SECA and the Illinois Condo Act and things of that nature. We've been doing these on a monthly basis, so I highly encourage folks after today's call, whenever you get a chance, to take a look at our website, look at some of the upcoming topics. You'll get invites for those as they come up. We'll be doing one later this month with Keogh and Moody surrounding electronic voting and things that boards can do to help take steps to modernize the way that they operate their elections and that nature. So this is just one of the latest and greatest installments that we've done. And I'm really excited about this one just because we are paired with our banking partners, Wintrust, Community Advantage. And we have a couple of really tremendous resources in Frankie and Amanda that I'll turn it over to here in a second. But just for quick context, I'm Eric Dazak, Executive Vice President here at Westward 360. I've been with the organization for about 12 and a half years, more newly responsible for business development and hopefully bringing on more clients to our portfolio. And then just for context, I previously was the department head for all of our association operations. So for a lot of any questions that you guys might have offline about things that you could be doing best practice-wise for your community, there's a lot of knowledge that I've got in my brain as well. So feel free to always utilize that as a resource in the future. But without further ado, I'll Frankie and Amanda from Wintrust Community Advantage introduce themselves and get into it. So guys, take it away.
Thanks, appreciate that. Yeah, go ahead, Frankie.
Good afternoon, everybody. My name is Frankie Sorrentino. I'm a Senior Vice President at Wintrust Community Advantage. I work with Amanda closely and this lending team here in Barrington. I've been with the company for going on a year now, but been in the industry for almost 10 years at this point. Been in the banking industry my whole life, out of high school through college, and looking forward to joining you guys and just being a wealth of knowledge and helping you guys, assist you in some uncharted territories as you guys navigate capital improvement projects, and really just be a resource for you guys to be, any directed questions you have at the end of the presentation or after today, feel free to reach out to either myself or Amanda. We'd be happy to assist in this process. Amanda?
Absolutely. Thank you for having us, everyone. I appreciate your guys' time today. A little bit about myself. So I'm Amanda Glatter. I'm the vice president here with Wintrust Community Advantage Bank. Actually been on the banking side now for 4 years this month. Just realized that. But I actually come from the management side. So my experience has been the gamut of admin to manager to director, as well as supporting my husband, who at one point served as board president on our townhome association board. So I kind of feel the experience from all the different avenues. Through this presentation today, I'll actually kind of speak to that a little bit too, just with my prior experience in my own association, but also with those associations I worked with in the past on the management side. So we're here as a resource, like Frankie said, not just for the management company, but also, for our clients to serve and make sure as well that we're providing that support and good resource that we can. So tonight, we're just going to dive in a little bit just into some general banking information, just good 101 stuff to know, and then also into the financing piece of association lending. It's a little bit different world than, going down to the dealership and getting a car loan or your mortgage, but it's not as difficult as I think people fear it is. So we'll kind of talk about that process a little bit and maybe get you a little more comfortable with that idea if there is projects that you have coming down the pipeline that you just aren't sure what that's going to look like financially for the community you're working with. So as we get started here, I'll just give you a quick overview, kind of what we're going to go over tonight. Talk a little bit about FDIC insurance, what it is, association banking options, different questions you might need to ask, some lending options, and again, what the process is, what would be needed for a proposal, underwriting guidelines, the steps to closing, and benefits for financing, if there are any. And then we'll do some quick kind of frequent questions we get asked. Of course, we'll definitely open it up for Q&A after this as well. So if you have something, please feel free to hold that question, and then we can dive into a little bit more specifics as well for you. All right, so FDIC insurance, something that you probably already know, but I like to throw in here. I think sometimes it gets skipped over and isn't necessarily carefully reviewed or watched with some of the clients. So FDIC insurance is, insured funds is the key, right? We want to make sure that if at any point in time there is a deposit issue or an amount that can be lost, we want to be able to get that back. So right now, current FDIC limit is $250,000 per association or per FEIN number. So your association, as you may know, has a number that you use for filing your taxes, your association taxes, just like you would with your Social Security number. It is directly tied to that. So that means the association, if you go over that limit, may have to use multiple banking institutions to support ensuring that money maintains its coverage. So there's just several options for that in the banking world. We might find a bank that has a capability at adding additional insurance. They might have a CDARS program, which is really a certificate of deposit, or a cash sweep program, which is very similar to the same thing. Basically, what that means is they take all of the funds, but they put it into different banks and then provide you with a different statement for those. So you still know where all of your money is, but you're still keeping under that $250,000 limit. A little bit for how Wintrust handles that. So Wintrust Community Advantage Bank is actually a bank under one big giant Wintrust umbrella. So we have 16 different charter banks now that we work with that can each provide up to $250,000 of FDIC insurance. And what that looks like, oh, I'm sorry, my slides got out of order here. I will speak to that a little bit later. We'll pop into how that program works for us. So different association banking options that you'll see: your operating and checking account, right? It's going to be your day-to-day items. You're just going to be general billing. Anything coming in there would be your association assessments, your regular monthly payments. And then you would have your reserve account or investment accounts that are going to hopefully grow you some money so that you can afford those capital improvement projects throughout the history of the association. So things like your roofing, your siding, tuck pointing if you have any brick on your homes or anything of that nature, asphalt, clubhouse remodeling, pools, that would be kind of housed in that reserve fund. I know Eric mentioned that you guys have people that come and speak to you in regards to how to plan for that. I think it's a really strong resource to lean on and to plan and anticipate what your community has coming down the road. So just keep in mind, that $250,000 limit is going to affect both of those accounts. So again, it's that one FEIN number that's really focusing on that. All right, so typically your operating checking, right, is going to be housed, if you're working with a management company, where that management company has their primary banking relationship. There are several reasons for that. One of the reasons is going to be, ease for not only management, but for them to provide service to you as a client, for them paying your bills, for them taking in those monthly assessments. You might find that your management company utilizes a software that works really well with your bank. So that might be a piece to it as well. But that operating account can be used for, again, day-to-day expenses. Generally, you have unlimited check writing privileges out of it. It might have some interest, but it's going to be pretty small. I think most folks, unless you have a bank that offers you a high yield checking, even on the personal side, will find that you don't get a lot of interest out of your personal checking account either. So it runs the same here. And then just a couple industry recommendations. Would love to have 2 signers on there so that people are, at least overseeing what's going on. And then obviously it's okay to have the management company listed as a signer because they're the ones operating the association. In the past, I have seen some associations choose to have a board actually signing checks, which can lead to problems, to be quite honest. Put my manager hat on for a second, and I've seen it where bills just take longer to get paid. So just reviewing that process really carefully. You still want to know who those signers are, who does have that ability to write those checks, something for the board to be aware of, but also be aware of efficiency. Obviously, if your landscaper is out there providing service for you, you don't want them to be delayed in getting their invoices paid. So super important to just be aware of that, and that timely as well. A little bit more into the reserve world. You've got several options for accounts. Money markets are kind of your traditional one. You see a lot of associations hold their reserve funds in. It's liquid. A lot of money markets will have check writing abilities. Typically earns a little more interest than you would from a checking, especially if you can get into a high yield. And then you have your CDs as well. Certificates of deposits are going to be locked up for a certain amount of time. So I always encourage boards when you're looking at those, make sure that you're laddering that in there. You're not taking all of your reserve funds and plopping it into one CD that's locked up for 24 months. You would want to be sure that you're reviewing it and seeing that those funds are available. So maybe you have a 3-month and then a 9-month and a 12-month, so that you have some funds coming available as needed when your projects that need to be done. There are brokerage accounts out there that could be utilized. I just tell people, make sure you know what those accounts are. Reserves are one of those areas where you may not see a ton of interest earning, but you also want to be careful because you really are, as a board, taking in those association assessment payments. You're acting as the board member on behalf of the association. You want to do the best thing for the association, right? One thing you definitely don't want to do is lose the principal of a reserve fund. It's really a tough situation to answer to homeowners if that did happen. So definitely make sure if you do start talking about brokerage funds or using T-bills and all of that, that you've spoken with the right people and you understand what that means for you. And then again, to that point, just invest responsibly. Consider where it is, consider how liquid it is, and consider the yield you're getting too. I mean, that's something to take into consideration. But all of those things come into play when you're looking at your reserve accounts. So as I kind of briefly mentioned before, we do have one particular account that offers a little bit more FDIC insurance due to the way our bank is set up with the 16 different charter banks. So we actually do have a Wintrust Max Safe account, quick diagram of how that works. But we can offer up to $4 million in FDIC coverage. So even if our clients do go over that $250,000 limit, how we function, we do have, let's say bank one, you've got 250,000 in. That additional up and above over that rolls into bank two, rolls into bank three, rolls into bank four. So every time interest is added or every time there is a contribution made to your reserve account, let's say, we continue to build that account with one of the other charter banks. So for us, what that means really is simplicity. You as a board get one 1099 at the end of the year. You see all of the association's money listed, really easy access. Again, because we have, all those charter bank relationships, we're able to transfer and do those things easily for the client as well. So if funds are needed at any point in time, there's access to those funds and clients readily available. All right. Questions to ask as a board member. So just some things to keep in mind while you're looking at your bank, banking information, maybe we're looking at your accounts. Do you know where it all is? A lot of times I ask people that question because they may find that over 5 years, the board has changed hands a few times. And lo and behold, you discover that there is an account at maybe a local credit union that you didn't even know or weren't aware of. Or maybe you were self-managed and then you hire a management company, same situation, right? Nobody knew about this credit union that a past treasurer had opened 10 years ago. You just need to make sure that you're keeping track of that and then updating those signers as time allows. So, and then time on those accounts and brokerage accounts where they're housed, just making sure, again, where all of it is. And liquid funds are key to paying vendors, right, for planned or unplanned expenditures. So going back to that CD conversation, making sure you know where those liquid funds are and where they're available so that you have access to them. Kind of tracking, will reserve funds need to be housed somewhere else? Are you working with a bank that provides the right FDIC insurance or the right coverage? Does the bank offer tools for account consolidation and protection? Are they on top of that? And just being aware of where, again, those funds are if they do need to get shifted. Who are the signers and have they been updated? As I briefly mentioned, boards do change over, right? We're all aware of this. So being aware of, again, where those accounts are, updating signers as needed, especially if you do have a self-managed community, or again, if you bring on management and you find, that there's an association account located at another bank. Oh, I just got a question. I'm sorry. I'll hold that one till the end. I'll go back to that. But just making sure, again, that they're all updated. So can the bank provide multiple profiles for online banking? So this is kind of an important one too. Not only do you want to know who your signers are, you also want to know who has access to the account, even online. It's super important to know that. So being aware of if there are multiple profiles, how many are out there. So just being ready and prepared for all of the information that could happen, or if you have questions as you switch over management companies or switch to management or switch board members. These might be some key questions to ask as the treasurer kind of goes out of the community as well. All right, some lending options getting into the association piece of financing. What's available, what's best, and maybe some things to know and be aware of. So some lending options. I'll talk a little bit about each of these and we'll get into them a little bit more throughout the rest of the slides. But first and foremost, you have your term loan. Functions just like your mortgage, functions just like a car payment. All the funds are there and available for you, the association, to be upfront. But when it comes time to making the payments, your rate is fixed at closing. It doesn't change unless you request it. And then there are certain term limits in place on that loan. So just like your mortgage, if you sign up for a 30-year fixed mortgage, right, this would function the same way. You have a 7-year term loan, the rate's fixed for the entirety of it. And then there are bank-imposed closing fees. Again, same as your mortgage. Any home you close on has closing costs, right? So that's very similar in this process too. So that's principal and interest payments start right away. That's the nuts and bolts of that one. It's really the easiest to compare it to. The next option associations would have when it comes time to do capital improvement projects would be a non-revolving line of credit that converts to a term loan. So what that means is the association has they have the funds available, they have access to them all, but they're not necessarily sitting in a bank account for the association to just pull out at any time. So on a term loan, the association gets the funds up front, right? On that non-revolving line of credit, the association actually has to submit documentation to draw on those funds. So I tell people, like, this is a great one if you're not sure on what the total project cost might be. Your contractor said, it might be we're looking at around 1.5, but it could come in at 1.2. Well, if that's the case, this is an option for you to say, well, let's do a line of credit where I can draw. And that way I don't take all of the 1.5. So it can change based on the project needs you have. The one thing that's important to remember with this one is that the association does start making interest-only payments as soon as money is drawn on that. So unlike a term loan, you're paying principal and interest right away. On your line of credit, it's just like a construction loan. As soon as you draw funds, you're going to start paying interest on it, but you don't start paying principal. A lot of banks do allow for you to pay down that principal. That's absolutely an option, but it's just an important piece to be aware of. Again, this one, the rate can be fixed at closing. So as soon as those loan documents are signed, and then you have some different term limit options. Just as an example, these are options out there. It's not all of the available options. So to be aware that each bank might provide you some differences. For instance, we do have clients we've worked with if they have a larger project that you might do a 24-month line of credit and then it converts to a 9-year term loan after that. So depending on the project, talk with your banker about that and they can really give you some guidance about what might be the best option, especially as you dive into those bids and start getting those in. And again, you're going to have bank imposed closing fees with that one. The last option the associations generally have available is a revolving line of credit. So this one is quick access, similar to the other lines, it closes the same way. Interest only is done at billing time, but it does have a variable interest rate. So a lot of these you'll see might change depending on how that agreement is set up. So being aware of that. And it does need to be renewed annually, and it may include an annual renewal fee. I have some associations that have utilized this, for instance, if they have interior condo painting and they're doing, they have 3 different buildings, they're going to do 1 building each year, and they're planning to pay it off within 9 months. And that's kind of how their process is going to go. This might be a great option for them. especially if they're doing an assessment, they don't know how many people are going to pay in. They know the project end date. They're okay with that renewal fee, those sorts of things. They're okay with that cost. But again, talking with your banker about your specific project is really going to help guide which one of these options makes the most sense for the project you have and your community. Boards generally know their homeowners well, so you want to be kind of just on top of how it's going to affect your homeowners. That's where your banker is going to really help give you some guidance. So, and then items that would be needed for a proposal. Again, this is going to be pretty basic across the board. For us, for our bank, and for just generally any bank, they're going to need to know where the association is, what's the name of the association, what the amount is that's needed. Again, if this is something that's not set in stone, that can be part of the conversation with the banker. So if you don't have all of your bids in, but you might have an idea, we can always start there. What's the purpose of the loan? This is kind of important because if it comes to something like we're just redoing the roofs, it's regular maintenance. But if it's something very large and structural, that the bank needs to review a little more closely. So just so the bank is going to need to ask kind of what's going on and in order to even help guide to which plan makes the most sense. What is the repayment plan? So the repayment plan could be guided by the board, could be guided by what financially might be needed by the association. It might be guided by the requirement of the bank too. So we do have, as a bank, have certain risk factors we look at and certain underwriting guidelines we want to follow. So it may come into discussion with that as well. But we generally ask, how does the association want to see this handled before we just assume. Total number of units, number of rentals, approved budget would be needed, all the financial statements, and then the most recent year-to-date financial as well. We do ask for the current delinquency report. I'll get into the underwriting guidelines here in a minute, but I tell people just always send us the delinquency report. Even if you think it's awful and it looks bad, let us take a look at it, because we might see something different that doesn't affect how we would look at the project, or we might go, yep, you're right. But at least, the decision is coming from the bank and not necessarily not asking the question. If you don't ask question, the answer is always no. So I always tell people ask question. All right, just some kind of standard underwriting guidelines. And, this will be sent out, so please don't feel like you need to take notations of everything. And again, please talk to your banker at any point in time if you have questions, because these things can get a little convoluted when it comes to looking at the numbers and what's all considered too. We're used to doing it. We do it every day. So that's what we're here for. But we do look at debt service coverage. Essentially, what that really long formula there means is, can the association repay and at how much? I mean, technically, we know that every association has homeowners that might go delinquent, and we have to plan for that risk. So even if the association is special assessing the loan completely back to the homeowners, for instance, we have to take on the risk that 10, 15% of those homeowners might not pay the loan in time. So can the association foot the bill in the meantime while they proceed to collect it? So that fancy long drawn out explanation is really what that means. I've included all that there. If you wanted to go through and try to calculate it yourself, you could. But honestly, that's what it comes down to, is we have to plan for that contingency on our end and that risk. We do look at cash and reserves. A lot of times I get asked the question, do I have to maintain a certain level of reserves, or what if we have really low reserve balances? Will you even be able to lend to us? The answer I tell people is absolutely yes, depending on all the other factors as well. We don't take reserves as a huge factor in it, but we do look at, does the association have a plan? If you come to us and you only have 25,000 in reserves and you're doing a ton of projects, well, that might reset your clock, right, for your reserve contributions. Or if you're doing one little thing, but we anticipate that maybe there's roofing that's coming up in 3 years, what's the association's plan then for that project if you're not reserving for it correctly? So just so you know, you can have a low reserve balance. It's not a make or break deal for us. Oh, it looks like I have.
It's just me. It's just Eric.
Okay. Sorry, I'm getting used to Google Meet, Eric. Bear with me. It's a new
all
one
good.
for me.
No, and all I was just going to add
Yeah.
to that is, and also not a bad idea to check in with management on some of those like reserves questions as well. I know that like we've gotten creative, especially on loans with that we partnered with Wintrust on in the past. We had one about 8 years ago with a townhome community that we still manage, where they had that exact reservation or that exact worry about their reserves balance and funding over time for like future projects that weren't associated with their loan. So what we ended up doing and working on with the Wintrust folks at the time was absorbing some of the loan repayment into the operating budget and then special assessing the remainder on that. And then all of the math ended up shaking out where we were able to finance not only the repayment of the loan appropriately, but then we're also able to keep the minimum 10% reserves contributions and then some. So we were able to kind of get a best of both worlds arrangement where not only was the loan helpful and instrumental in them being able to afford the needed projects, which were 3 roof replacements of 5 buildings at the time, but they were also at the same time able to put away reserves for some future projects. They had a retaining wall they wanted to save up for, some leak problems unrelated to the roofs that they wanted to create a budget for. So that was really helpful in getting Wintrust guidance on that to put them in a spot where they weren't feeling like they were putting themselves in a bad spot over the length of that loan and not being able to save simultaneously for other projects down the road that might come up.
Yeah, absolutely. It's super. I mean, that's one of the things we look at, right? When we're looking at that reserve contribution too, is what's coming down the pipeline and what's coming down the road. And then again, having that conversation of, are we doing this out of the operating budget? Are we doing it as a special assessment? Maybe it's half special, half operating, to that point. So again, we look at it, but it's not a make or break deal. So again, I always tell people just reach out to your banker. The same owner occupancy ratio, we'd like to see that at 51% of homeowners actually living in the units that are not rentals. We don't want to see too many rentals there. I tell folks, if you have a large investor property, unfortunately a situation where half of the building is owned by one investor, we just have to consider that as a higher risk then, especially if the association is special assessing. If you've got one person that owns 10 units and they're going to get hit with 10 special assessments, we do consider that as well. So delinquency is not to exceed that 10% of gross annual income or number of units. Again, I tell people just send us your delinquency report. Let us look at it because there are some things that we might not look at. If you have a homeowner who has a $25 fine that's 90 days past due, that's not going to make or break the deal. So just being aware of that. And then your debt to unit value, again, super fancy, wonderful little way for us to figure out kind of what the value of the homes are in the neighborhood as an average. We do look at that as part of the factor too when it comes to lending to communities, but there is some wiggle room on some of these numbers if needed. I mean, if I have a client that comes to me and says, we're redoing all of the siding, I'm redoing the brick, I'm putting new stone on the front, we're redoing the roofs with this loan, and their debt to unit value is 11%. Well, hopefully, right, the idea of doing some of those things is if I'm putting new roofing on, new siding, new stonework, I'm modernizing things, well, your home value more than likely is going to increase as well. So those things are things that we're aware of, but these are general guidelines just to be considered. All right, so what actually happens when you need a loan or when you need financing? So first step is always getting your proposal letter, just like everything else, right? We're not going to go to you and talk to you of all the numbers and not have anything actually presented physically to you. So that proposal letter is the first thing that's issued for the board to reserve. Once we receive that back and signed, we do go through our underwriting process. Generally, I tell people as lending officers, Frankie, myself, and Derek in the office and all of our staff actually that handle the proposal side, we review all of the numbers on the front end too. So we're taking a close look at the deal before we even send you a proposal letter. The only things I've seen get flagged that maybe weren't discussed during that proposal process were a lawsuit that the association is part of that might lead to further questioning on when it comes to a credit review. But once underwriting is completed, we send out a commitment letter. So generally speaking, that process, and I have a timeline I can show you, but usually is 7 to 10 days once we get that proposal letter that we're moving on. Loan documents will be drafted as soon as we have the commitment letter done and signed, and as well as soon as we receive the association loan fee as well. So that proposal letter outlines what that fee is for closing, and once that's received, then we start that loan documentation process. those documents are reviewed by the bank attorney, and obviously the association can present them to their attorney for review as well. If at any point in time the association decides to do that, that's absolutely acceptable. Then we issue those loan documents to the association for signature, and then closing and funding is completed. So generally, you're going to see the entire process. In emergency cases, we do push for 30 days because we know some clients might be in an emergency situation. Unfortunately, I've had in the past an association that was told that they needed to replace their roofing. And so in order to maintain their insurance coverage, and they were kind of in a hurry to get it done. So we were able to handle them and help that through that process. But generally, you're going to be right around that 60-day mark. So I tell people keep that in mind when you're starting your projects. It's something just to be aware of, because if you do find that you need financing, you might be able to use some of your reserves on the front end for a deposit, but you want to be aware as far as that time frame too, when those funds become available in order to pay your contractor. So just being aware of that's really good on the front end. So a little bit of a timeline for you. This is really small. I'm sorry. I wish I could make it bigger. But again, generally speaking, once we get the proposal, it's about 7 to 10 days when we finish our full underwriting process. And then again, from typical start to finish is about 60 days. So just being aware of that. Some of the benefits you might find from financing. So it provides availability for those funds immediately, right? So you can get those capital projects done in a timely manner. You're able to move things maybe up in your reserve process. It provides an option for homeowners to have a payment plan on their special assessment. If an association does need to do a special assessment for their repayment, I generally work with that association on timing to say, give homeowners the option. If you give homeowners options when it comes to doing a special assessment, they obviously don't love the special assessment, right? Nobody does, but at least if you give them options on how they're going to pay it, then they feel like they have a little bit of like, okay, I've got a little bit of my own decision making in this. So we generally work with associations and say, you have them pay their special assessment up front if they want. They don't need to be part of the payment plan, and it saves them from paying the interest on the loan. So it's an option to be a cost-saving factor for those homeowners as well. Financing allows the association, kind of to Eric's point, you can modify the budget, you can increase assessments if you need to, repay the loan over time, or just modify things to make sure you're still doing that contribution to reserves as needed. You can also receive more competitive bids. If the work's getting done all at once, for instance, if you're doing all of the roofing at one time versus phasing it over 5 years, your contractor is going to say, yes, we can lock in our price. I've had contractors maybe lock in pricing for 2 years on certain projects, but never more than that. So if you're looking at phasing anything over that, over that time frame, it's very unlikely that you'll see the same price for one roof that you got for the next. So it allows the association just to get some more competitive bids and get it all done at one time. The other benefit, right, is your homeowners aren't living in a construction zone for 5 years. They're only living in a construction zone for 1 or 2 years. So that was my next point. Sorry, less disruption for those homeowners, right? So again, just getting it completed over a shorter period of time. Fixed construction costs, locking in the payment terms as well. Super great for associations to budget, right? Eric, you kind of mentioned one of the presentations or education sessions you had previous was insurance and the volatile market there. If the association can control and lock in some of those payment terms for a project, that also helps that budget in the future too. So if you're locked in for a 5-year term loan, this is your payment versus a 5-year phasing of the project. And by year number 5, your price might double. You don't know. So I think it just gives the association a little bit more budgeting control too. And then a loan can help the association maintain healthy reserves and not use all that available cash. For instance, I have a client I'm working with right now. Their entire project is $1.9 million. They are choosing to subsidize a portion of that with their reserves, but they don't want to drain their reserves because there are other projects they need to look at. So definitely something to pay attention to, those projects you have coming down the pipeline. But financing gives you the ability to maintain maybe some of those reserves to put towards other items that are coming up. So just some quick FAQs we usually get. So who is the borrower on the association loan or the LLC, the LO line of credit? The association is. We do work with the board to get those documents signed. We do work with the board to open any accounts that might be needed, or we work with management to do that. But ultimately, this is a business transaction. So this is treated as a commercial loan. The association is treated as a business. We don't pull individual credit reports or anything of that nature. The association is the one taking the loan out. How can the association repay a loan or LLC? So the association has all the options. You can use your operating income, or you can special assess as well. I have seen in situations, as mentioned, that the association might do half and half. We're going to take half of our reserve contribution and put it towards the loan. So we're still putting a good chunk away, but we're going to special assess homeowners for the remaining portion because we need to plan and consider what's coming in the future. Is the association required to hold reserves with the bank? We do ask for associations to hold some funds with the bank until the maturity of the loan. Depending on, what the reserve funds are at, I tell boards to kind of watch that number as well. The last thing you want to do is have $200,000 available in reserves and then tie up $200,000 in a bank and feel like you have to maintain that. So work with a bank that's obviously going to work with you. We have clients that reach out to us on occasion that all of a sudden they have an emergency and need to handle, and we do modify or amend that as needed. But you just want to be sure that that's going to be a possibility with that bank you work on your financing with. So just being aware of that. And then what is secured to provide a loan, right? We don't take a down payment. We don't put collateral. We don't put a lien on anybody's house or on any common property. We actually have a document in the loan packet that is called the assignment of assessments. And essentially what that is, the association says, if we default on our loan repayment, bank, you can reach out to homeowners and tell the homeowners they have to pay you directly. We have never had an issue with default. It's never come up in the 26 years that Wintrust Community Advantage has been in banking and HOA banking. And honestly, the reason being is usually what happens, the association might switch management firms or switch banks or something of that nature, and we're kind of the last to find out. Our payments are set up on direct debit, so it's kind of just something that you just don't think about at the very front end. So that's usually when it happens. It's usually corrected pretty quickly. But that is what we're doing. We're not putting a lien on anybody's property. So do all homeowners have to participate in the loan? So I'm going to say no, and it also depends. The financing can be a way for the board to present members, with the ability to pay a special assessment up front. But if the board is using operating funds, essentially that homeowner, yes, is participating in the loan by paying their regular assessments every month. So it's a yes and no. The homeowners might be involved no matter what, if they're paying their regular monthly assessments. But if it's a special assessment issue, if they decide to pay their special assessment up front, then they're not paying on the loan. And if the homeowner sells a unit, what happens? Because there is no lien on the property, homeowners are able to sell their homes at any point in time. So we don't have to worry about that at all. When an owner sells a unit, there might be any contingencies in the declaration or resolution documents of the association that might require that special assessment to be paid up front. Usually that is the case, that it's somewhere in between that agreement with the buyer and seller. I don't know of a homeowner that wants to purchase a home that has a special assessment and not have it paid off. So generally speaking, that is what happens. The association sees that income come in and goes to as a principal pay down towards that loan. Go ahead, Eric.
I really just love that you brought this up because it's really relevant to a lot of our clients. This tends to be something that gets missed, this last point here. And not that it's a deal breaker or a true problem if the board doesn't make that distinction, but if it doesn't, it leaves a lot of questions open-ended without very clear answers for those involved with that unit sale. So whether, ultimately, if it comes down to negotiation between the buyer and seller, that's ultimately their prerogative, but often it's a lot better if we have clarity from the board when they took out that loan that there was a resolution passed giving some sort of direction, whether that's stipulating that at each closing the seller will have to be responsible for that special assessment. Often that's how boards usually operate, just because the folks that are currently owning that, it was assessed against them. A buyer isn't going to have an appetite for wanting to take that on. Conversely, sometimes it's left where the buyer can inherit that special assessment, particularly if the improvement or the maintenance item that's being handled is going to, like, on a long-term basis, benefit the future buyer. Sometimes it's been negotiated that way, but often we'll get the question on the management side from the attorneys, the lenders, everyone involved with that transaction, who's responsible for this? And much easier on our end, and on the bank's end too, and really everyone for that matter, if there is clarity on, is this special assessment transferable? Does it have to be paid at closing? I often recommend that at closing or before would be better, just because it helps guarantee and put some level of assurance that that debt is being paid off. You don't know that new buyer that's coming into the association. They might be the most solvent person in the world and no financial problems, but often you have a little bit more assurance that if it's paid at or prior to closing, you're going to make good on getting that loan repaid and then apply that principal payment to the outstanding principal on that loan as well.
Yep, absolutely. And then too, a lot of banks, when people do sell their homes, or let's say, I always say if somebody wins the lottery or, they have a tax refund they didn't anticipate, they can always pay down early on. We don't have a prepayment penalty on our loans. So a homeowner could absolutely pay off their portion of the special assessment. The association could just utilize that to pay down the principal of the loan. And then all of our loan agreements do include, generally 2 reamortizations per year. The association could always do more. So visiting with that kind of information with their bank you're working with is important too. So you understand, how is that prepayment going to be handled? We take it as a principal pay down. It's applied to the loan immediately. There are some banks that do take that prepayment and they put it into sort of an escrow fund and then use it to make the monthly payments. So the association actually doesn't see any cost savings or interest savings from that piece. So it's important just to know how that's going to be handled once it does happen. All right, a couple other things. If the association has an existing loan in place, what do you do? Most banking institutions will require that existing loan be paid off by the new lender at the time of closing, refinanced into the new lender. The second facility could be created to kind of keep track of that loan separately, but most times you will see that a new lender does not want to come in and be second to that other lender. So being aware of that. And can you apply for a loan when there's another one in place? Absolutely. The current lender may provide you a second loan if the association qualifies. They may, if the association chooses another lending institution, payoff requirement may fall into place. So there is a couple things to consider as well. How the bank is going to handle it. If you would refinance to another bank, is there a penalty for that? Just being aware of those things when you're reviewing those loan documents. So we've got about 20 minutes left. So I'm going to open it up for questions. I think there was a couple, and I'm going to stop sharing my screen. Unless we need to pop back to something else. But I can pull it up as needed. So do we have any questions out there? Or Frankie, anything you want to add that I missed?
No, you did a great job, Amanda. I think just reiterating the fact, really bringing us into the process early on. There's no obligation for you guys to involve us at the preliminary stages when you're just trying to gauge, the scope of the project, the timeline, the cost. We're here to just support you guys. And the proposal phase, although we do require a little bit of, financial due diligence up front, we just want to really ensure that we're providing, an accurate depiction of what we're willing to go out with and assist with from a lending front. And, what changes we'll need to see in order for us to help facilitate your association's needs. But, again, there's really no timeline for that proposal phase. We have projects that we've worked with that, have been at the proposal phase for a year, or even longer at some points. Every project has a story. And, a lot of times we really lean on reserve studies and, really just that upfront due diligence to really pre-plan for what is the final scope of the project and where you need us to step in and assist. But I think Amanda did a great job, and we're really just here to assist Westward 360 and your boards, and really just be support for you guys to help you through this process. But again, I know we're going to be passing along the presentation along to you guys, but we try and be as transparent as possible. I know it was mentioned earlier, but our lending team doesn't work on commission. We're here to just support you guys. I know Amanda's a part of an association. I know I am as well, and her family and mine. It's we understand that a lot of these large capital projects can be burdening to many families, and really just providing accessibility to those that can prepay and those that might need a financing solution to not make it a strain on their families is really a rewarding side of what we do. But yeah, I think that's enough of my rant. But again, Amanda, great job. Eric, we're just here to support you guys. So any questions you guys have?
I was going to say, I did see one question in the chat from earlier. What should be the goal for an association to set for its reserves for a 10-unit, 100-year building? That's a very loaded question. Honestly, I hate to say it, but I'm going to give the attorney answer. It depends. There are so many factors that can come into any association reviewing its reserves, whether it's a 10-unit community, 25 to 200 unit. What is the association responsible for maintaining? Is obviously one of the big questions. And then what is the age of everything and the maintenance level of everything? All that can come into play. From a banking standpoint, I can't give you that answer. I can definitely help you with, maybe an investment plan or, lettering CDs to make sure that your cash is liquid. But you really should bring in a reserve specialist for those types of questions, just because they're going to be able to look at your building and say, here's where you're at. Here's what you need to plan for the future. So I'm sorry, I can't really answer that. But I would definitely reach out to a specialist for reserves. Any other questions?
We did have one of the pre-submitted questions, I believe, actually came in from, I think, an attendee that's on right now. Larry Widmeyer, are you on the call?
Yes, thank you.
Yeah, of course. It looks like the question that you had asked, I believe, was if we sell an asset, what are the best short-term investments? What relatively liquid investments are available to an association?
Yeah. So I think it kind of depends on what you're planning to do with those funds. If it's something that you really just want to leave, we're going to need it in 2 months, I would plop it into, a high yield money market. That would probably be the safest place for it to be, especially if it's going to be super short term. So again, there are some CDs out there that might be an option if it's, 6-7 months, up to a year. But if it's going to be quick turnover, that's probably where I would plop it. But it kind of depends on the situation. So.
And we hope to put it into our reserve account.
Oh, sure.
As part of our reserve money, but it'll still be within 24 months.
Okay.
We probably have to use some or all of it.
Yeah, I mean, if you can, if you don't need it and you don't need it to stay liquid, you could put it into a CD. You would definitely get a higher interest rate at that point in time. But again, like our max safe right now is at 3%. So that's a completely liquid account. I would probably just plop it in there. To be honest with you, I think that, if you need to keep it liquid and available, I guess I don't know if there would be a reason it would bounce somewhere else or be needed somewhere else. I think that would be part of the conversation. So if there's a possibility,
I think it's probably at least 24-month out.
Yeah.
So we've got roughly 2 years to make a little money with it before.
Sure.
We have to assess where we need it.
Okay. Yeah, I mean, then you could definitely look at doing a CD as well.
Thank you.
And just one thing to add to that. Sorry, I didn't. Just we have noticed with the volatility in the market. I know many of you've seen with tariffs and treasuries and T-bills and just the fluctuation of overall rates. A lot of banks are going shorter term to maximize that yield on your returns. So another thing too is just, I know you had mentioned, Larry, that you're looking at 2 years out, but it might be beneficial to look at promotional rates for shorter term CDs. It might maximize your return on those stagnant funds that you might not need to tap into at the immediate need. But having that flexibility with our max safe solution as well, should we see a significant decline in the short to near term, gives you that ability to flex the funds, as needed. So just wanted to add that too.
Thank you. Appreciate it.
And then I see a few questions that were posted in the chat that I can address here as well, in conjunction with you guys. So taking a look, I know Jim's is a little bit more specific, so let's get to that in a second. I will say just quickly for Calvin's question, just regarding reserve studies and reserve specialists in general, we do have really good relationships with both reserve advisors and building reserves. I'd be happy to circulate their contact information if you are interested in getting a proposal from either of those institutions. They actually give us preferred pricing for Westward 360 customers as well. So typically that results in about a 10 to 15% discount from their normal rates. So if you are a community that is looking at a reserve study in the near future, both of those options would be good. I can also throw that in the chat at the end of this call too. Related to that, Lori also brings up a good point that is, and I'm glad reserve studies came up, because all this kind of like Amanda had mentioned, and reserve studies can often help inform some of these lending opportunities that you might be looking at, especially if you don't have that cash on hand right now. So I do encourage folks, if you have not done one, especially if you have a fairly complicated community, maybe like buildings like Calvin's where you're 10 units, often don't have as many elements under your tutelage or that are your maintenance responsibility as a common element. So the reserve study doesn't go as long of a way as it does for some of these complex communities where you have a ton of different mechanicals, a ton of different, building elements that are all under your maintenance responsibility as an association. So the efficacy of a reserve study can kind of change depending on how complicated and large of an association you are. Lori does bring up a good point in considering we're talking about budget season as well in the next month or so here. It is very possible in the state of Illinois and in many other states. It already is a requirement in states like Florida. In states like Nevada, there are requirements around this, but reserve studies are very likely to become compulsory and mandatory in the future. Whether that happens in 2026 or 2027, not quite known as of yet. But given that ultimately, because of things like the Surfside collapse in Florida years ago, because of the volatility in things like weather events that are causing insurance premiums to drive up, or weather even impacting just the overall maintenance of associations, that was a big factor for Surfside and its proximity to the ocean and just weather exposure and things like that it can do to the metal infrastructure and the framing underneath everything that everyone's living on. Those can be really impactful. So given that, I do encourage folks, especially these complicated associations, if you have not gone out to bid for your reserve studies, now's a good time to do it, because ultimately pricing is going to be at its best right now. You can imagine that at the minute that those become mandatory in the industry for a state that doesn't currently have mandates around that, that's an opportunity for those institutions to jack up their prices. And that's well within their right. So you might be getting more favorable pricing if you look at reserve studies and budgeting for that now than you might otherwise see years down the road. I will say to Jim's question, wondering if the three of you would be able to talk with me or us to explore potential for near future roofing replacement to see if this is a route feasible, or if this is a route or a feasible option for us. Yeah, absolutely. If there's, if you want to reach out to Amanda, Frankie, I know you mentioned Roberta Chalmers is your manager. If you want to include all of them on that message, or even feel free to include me, they would be a great resource to be able to tell you what some of those lending opportunities might be, depending on what sort of projects you're looking at budgeting for, whether it's for next year's budget or 27, 28, 29, whatever the case might be. I did see also,
I'll throw my contact information into the chat here too, just so people have that. So
thank you.
Yeah.
One of the pre-submitted questions too, just since we have a couple more minutes, was actually on the topic of reserve studies as it relates to all of this and whether or not they're super necessary and helpful. I kind of alluded to it, but my personal and professional hat, Amanda made a good point. I kind of call it like my manager hat versus like my practical hat, right?
Yeah.
Like on a management level, we'll always encourage them, and that like they are a helpful tool, especially if they become mandatory and become a necessity to have. It's not like you'll have much choice about it, and in the near or distant future. I will say my personal opinion is kind of like I mentioned, for smaller associations with not a lot of maintenance responsibility as common elements. So for instance, like if you're a small single family home subdivision association and you've got 30 homes, most of the maintenance responsibilities are individual homeowner responsibilities. All you're responsible for is landscaping, paving, and snow removal. You can imagine that reserve study is probably a little bit less helpful for you, right? Like it's a lot of upfront cost for just knowing that, hey, you've got to start budgeting for paving if you haven't done it in the next 5 years or whatever the case might be. So is the reality that reserve studies sometimes for smaller communities with not a lot of complicated elements that the association is responsible to maintain? Yeah, maybe it's not as helpful or as detailed of a document. Still can be if you don't have a good sense of what those budget numbers are, if you don't have a good sense of what the useful life for them is. And that can help inform whether or not you do need to engage with, folks like Frankie or Amanda to say, hey, do we need to budget for this now? Is this building element failing now and we don't have the cash? Because that's the absolute greatest opportunity to be talking with a bank and looking at your lending options versus, hey, we know that we have, in 10 years, we have to save up for our roof replacement. We already have $300,000 in reserves. We know it'll cost $600,000. Maybe we have some time to start saving up for that and just budgeting for it as a capitalized expense from our reserves account. So good to look at that now, but I will say the reserve study can help you start planning for that and give you a sense of whether or not you need to come up with those funds now, or if you can kind of wait and slowly build up those reserves and earmark some of those deposits for some of those future projects down the road too.
Absolutely. Any other questions? Well, I appreciate your time tonight, everybody. I think we're obviously here as a resource again for anything that you have come up in the future. You can reach out directly to myself, Frankie, or go ahead and go through Eric as well if needed. So anything you guys need, or if you think of a question even, after this and just want to reach out, please feel free. Here to answer anything. So rather be a resource for you. But thank you all for joining us.
It was nice meeting all of you as well. And I know we'll circulate our contact information afterwards. Whatever you guys need, feel free to just drop us a call. We're happy to assist and just support you guys along the way.
Thank you, everyone. Really appreciate you all attending. If you've got any suggestions, we'll send out a post meeting recap that just has that recording and everything a little bit later this week. If you have any suggestions or recommendations on future topics you'd like to learn more about, or other things that would help you just be a better educated board member in your capacity for your association, do let us know. We're really excited to be running this program and doing this on a monthly basis. So if you do have any future topics you'd like us to cover and start getting on the books for later in the year, just feel free to reach out to me. Or just submit that with your RSVP for the next one later this month if you want to attend that, and we can take that along as well. Thank you, everyone, for attending. Have a great night, and stay tuned for the recording a little bit later this week.
Thank you, Eric. Have a good night, everybody.
Have a good night,
Thanks,
everyone.
everyone.